Better System Trader, Episode 34.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 34, and I'm your host, Andrew Swanscott. This week's guest has over 25 years experience in the financial markets. He worked as a head trader for a CTA and published a number of popular trading books on futures, options, and stock market seasonality. He also spent a number of years writing a weekly column titled Kaeppel's Corner and publishes his own trading ideas and research on his blog, Jay on the Markets. He is now Portfolio Manager for Alpha Investment Management, offering strategies such as the Alpha Multi-Income Strategy to investors. In this week's episode, we discuss a number of seasonal tendencies, how they can be integrated into a trading model, the applications of the known trend index, and why most traders fail. So let's get to it. I hope you enjoy the chat with Jay Kaeppel. Hi Jay, thanks for joining us today. Can we please start with a little bit of background on yourself?
Sure. I've been trading for over 30 years now. I was a software developer for futures and option trading for about 15 years. That evolved into being a commodity trading advisor, a head trader there for about 9 years. We made money 8 years, lost 2% the other. Spent 9 years with a company called Optionetics as an instructor, primarily in the options, but also in futures and ETF trading. Written 4 books, including Seasonal Stock Market Trends, 4 Biggest Mistakes in Futures Trading, and the 4 Biggest Mistakes in Option Trading. And just earlier this year, I became a portfolio manager again with a company called Alpha Investment Management in Cincinnati, Ohio. And if I can mention their web address is alphaim.net. And I manage a program called the Multi-Income Strategy. And last but not least, of course, my blog is jayonthemarkets, all one word, .com. And that I don't write on any kind of regular schedule. It's just when I think I have something that might be of interest, then I shoot it out.
Okay, great. So if we just step back to how you actually got started in trading, what drew you to that as a profession?
Well, it's sort of a joke, but what I always tell people is in college I majored in personnel, and then I got out of college, I got a job in personnel. And that's when I realized that I hate people. So I was gonna have to do something with the numbers, So it kind of I got over that, but But that's kind of just, I always had an interest in the market even when I was in college. So, it's one of those things. If you're into it, once you get in, you're hooked, and you just stay with it.
Okay. So I think perhaps you mentioned that you started out trading options. Was that correct?
I actually started out trading stocks,
Right.
And then I started trading futures in about 1984. Some of the index products and the bonds and some of the grains and things like that. And probably started trading options probably in the late 1980s.
Okay, so what initially drew you to stocks and futures?
Well, back in the day, stocks and futures were the only thing there really was. In the early 80s, just to give you a little perspective, when I started, you couldn't trade an index fund. There was no such thing. If people wanted to emulate the Dow, they had to buy 30 stocks and just the right number of shares. So, when index products started coming out in about the mid 80s, that was a big deal. And, it's really opened a lot of doors for a lot of people. And the ETF market nowadays is it's one of the great opportunities for people to really get into all kinds of different things that they couldn't get into before. Currencies, commodities, interest rate products, etc.
Yeah, sure. So if we move up to your trading today, you've already kind of mentioned it a little bit, but what kind of trading approach are you using today? What markets, etc.?
Well, one of the things that I want to mention is, especially for people starting out, I had someone who was a mentor, kind of a mentor, and he kind of pushed specialization. He said, if you know something about the crude oil market, you should focus on that. And I think that's a viable alternative. However, I've kind of gone a different way. I have a very diversified approach to trading. And I'm not even really talking about a diversified portfolio of stocks. I'm talking about a diversified portfolio of strategies. And not to get too nitty gritty, but basically, just to give you an idea, about 30% is in buy and hold. Mutual funds that I've held since like Ronald Reagan was president. With any luck, I'll never sell them. My kids will inherit them. But if I need the money, but the reason is, if you look at a long-term chart of the stock market, in the long run, it goes up. So I always want to have some exposure in the stock market. Another 30% is in what I would call investment strategies. If you go to my blog, jamthemarkets.com, you'll find there's a few strategies, like, for instance, trading sector funds using momentum. At the end of the month, you find the 5 Fidelity sector funds that have gained the most in the last 12 months. You buy and hold those until the next month, and you do the same thing over and over. That's had a tremendous long-term track record, 18 to 20% a year on average. So that kind of investment strategy, kind of a canned approach. And then 30% is basically trading. And that can be ETFs, it can be futures, it can be options, long, short, just basically trying to vary the portfolio. And then the last 10% is either speculation or hedging. And the reason I put that in there, another thing to mention, for beginners, but also for people who've been trading a while, everybody gets the urge once in a while to pick a bottom or pick a top, and when you get the urge to pick a bottom in something, you get that voice on one shoulder that says, yeah, go for it, bet the ranch. And on the other shoulder, you got the voice going, no, that's stupid. Nobody ever makes money doing that. Well, what I tell people is if you have 10% of your portfolio set aside, you can go ahead, especially, I know we're not going to talk too much about options trading today, but if you do learn a little bit about options trading, if you decide to pick a bottom in something, you can take a very small portion of your capital and buy a call option, for example. And you have the opportunity to make a good rate of return. But if it turns out that it was a stupid idea, like the voice on the one shoulder said, that's okay. You don't lose very much. So, that's kind of a long-winded answer, but, basically just trying to have a portfolio that does a lot of different things and basically can attack the market from a lot of different angles.
So you mentioned your blog there. You've got quite a few unique ideas and research that you publish on there. So where do you get these ideas from?
That's a good question. That's a good question. A lot of it, the seasonal stuff, that started out back in the 70s. Yale Hirsch, Norman Fosback, those guys were kind of the pioneers of seasonal trading. Sell in May, that was Yale Hirsch. Monthly seasonality, that was Norman Fosback. And there's a lot of markets that you can do things with that. And then a lot of the systems are just things that evolved over the years. And then the option trading, again, like I said, I taught options for 9 years. And one other thing that I look at is in some software that I use. I'm not a big Elliott wave guy, but if I find a market where the weekly and the daily Elliott wave is pointing in an up direction, in other words, if they're in agreement, I find that to be a good time to put on a short-term trade or an option trade. And those are some of the trades that I write about on the blog.
Okay. So we might switch to seasonality now because, as you mentioned earlier, you published a book called Seasonal Stock Market Trends,
right?
Which covers quite a number of seasonal factors. I'd just like to discuss a few of those with you today.
Sure.
Now, one that often gets publicity this time of the year is the Santa Claus rally.
Right.
Can you tell us a little bit about that?
Well, different people define it different ways. Some people look at different time frames just to kind of spell it out. And I recently posted this on my blog so people can find it. But the Santa Claus rally, as I define it, starts at the close on the Friday before Thanksgiving, which is actually a couple days from now. and then it extends through the close of the third trading day of January. Okay, so it's basically about a month and a half, give or take. And the historical record is over the last over the last 66 years, it has showed a gain 55 times. So that's about 84%. So 84%. That's not bad. Doesn't the one conundrum, of course, the one catch with any seasonal trend is there's no guarantee it's going to work this time around. But basically the way that I suggest people use seasonal trends is if the seasonal trend says that a given market is supposed to be going up, and based on maybe some trend following or oversold indicator that market is going up or looks like it's about to bounce, that's a great time to jump on that trend. Okay. And then one other thing I'll mention about seasonality is, I have something in a note here that I just wanted to, part of the reason for looking at seasonal trends is that one of our primary jobs as traders is to find an edge, right? To find something that people aren't using. So whenever I speak live, I always, ask, okay, who's ever used technical analysis to find a trade? And everybody raises their hand. And who's ever used fundamental analysis to find a trade? And a lot of people will raise their hand. And then I say, who's ever used seasonal trends to find a trade? And, me and maybe one other guy will raise our hand. And so then I ask, it's basically a rhetorical question, but if you're looking for an edge in the market, does it make sense to look A, where everyone else is looking, or B, where no one else is looking? And so that's kind of how I got drawn into seasonal trends.
Yeah, okay. So I understand that there are seasonal tendencies in other holidays. What has your research found about that?
Well, basically what I found in holidays, I've read a lot of research, and a lot of people look at individual days like, they argue which is better, the day after Thanksgiving or the day before Christmas, this, that, the other thing. Here's what I've found and what I suggest. And this is in my book. There's a chart of it. It's pretty consistent. The 3 trading days before and the 3 trading days after every market holiday is a good time to be long the stock market in the long run. In other words, if I look at if I have a chart, let me just take a look at this real quick. Going back to about 1955, just to give you an idea, if you start with $1,000 and you invested in the Dow Industrial Average only during those 6 days, every time a holiday came around, so 7, 8, 9 times a year, however many holidays there are, that's grown to about a little over $10,000, which doesn't sound like a lot, maybe in terms of raw numbers, but in terms of consistency of growth and remembering that you're only in the market for about 50 days a year, it's a phenomenal rate of return. So, that's part of my overall monthly seasonal strategy is to just be long the Dow or the S&P those 6 days every time. So in other words, if we have Thanksgiving coming up next week, then you would get long the Friday before, and you would sell the Tuesday after Thanksgiving. And again, that doesn't mean it's going to be up every year or every period. Clearly, there's always going to be ups and downs. There's lots of factors that affect the market, but the long-term results have been pretty consistent.
Yeah, so what do you think causes these tendencies around holiday time?
Could be alcohol. I honestly don't. I honestly don't know. I had someone explain to me once as a general feeling of euphoria. Well, okay, it works for me. One thing I should admit is that I tell people that I am a proud graduate of the school of whatever works.
Yeah.
So, a lot of people, they want an explanation of why something works, and I understand that. And if somebody's not comfortable that an explanation doesn't work for them, I absolutely understand that. But I've done enough and seen enough that if something works, I'm willing to go with it. So the holiday trading kind of fits that bill.
Okay, that's a good point, Jay. Thank you. So now let's switch to monthly seasonal trends, because we often hear that there are certain days of the month that are more bullish than others. So what have you found about that?
Okay. Well, I'll just list it right out. If anybody wants to write know while I'm talking, they can do that.
Yep.
One of the most consistent trends that you're going to find is monthly seasonal days of the month. And I'll refer people to a book that was written in 1975 called Stock Market Logic by a gentleman named Norman Fosback. And he was the first one to really talk about monthly seasonality. And so the system that I look at works like this. If today is within the last 4 trading days of the month or the first 3 trading days of the month. So basically you're talking about 7 continuous days every single month. The last 4 plus the first 3. And then adding in trading days number 9, 10, 11, and 12. In other words, the very middle of the month. And then, of course, if you have a holiday, the 3 days before and the 3 days after. Okay? So now here's the catch. You have to do it every single month. Okay? Which is kind of a lot to ask of a lot of people. It's a lot of trading. But here's the bottom line on that, just to give an example. And again, I'll go back to a study that I did starting at the end of the calculation starts at the end of 1955. $1,000 invested in the Dow has grown to about a little over it's grown about 3,400% since that time. So basically 60 years of history. It's grown from 3,400%. This system, and we're not talking taxes or commissions or any of that, has grown 38,000%. So it's a huge difference, just a phenomenal difference. Right. And it's one of the most consistent, if you look at rolling 5 and 10-year rates of rates of change over 5 and 10-year periods, it's extremely consistent. But like I said, the big catch is, what do you have to do? You have to follow it every month. And that's a difficult thing for a lot of people. Because even though the numbers are very clear, and just also I mentioned a minute ago about people want a reason why things work. This one actually does have a reason for it, I believe. And Norman Fosback wrote about it. Is basically the theory is money moves the market. And when he started writing about the month end, beginning of the month period, what he was saying is that at the end of the month, there's always money moving into the market. And so at the end of the month and the beginning of the next month, there's money managers putting that money to work, which makes sense to me. Mm-hmm. And I think I can prove it, although I don't have a chart to show you at the moment, except the one in front of me. But the period I mentioned during the middle of the month, okay, trading days 9, 10, 11, 12. Why would that be a good period of time to be in the market? Well, actually, from 1955 through into 1980, it really wasn't. The market was mostly flat during that time period. And then from that point, the numbers started going up and up and up and up. And so the question I always ask people when I show them the chart is, well, why do you think that is? And the answer is that that's when IRAs became wide open to people. And so ever since then, at the beginning of every month, the end of the month, and the middle of the month, a lot of people, money comes out of their paycheck automatically. They don't even think about it. It goes straight into the market. Mm-hmm. So there's built-in demand for stocks every month at the end of the month and the middle of the month. Mm-hmm. And so sometimes other factors, of course, can work against it. But, that's basically why it works. And one other thing I'll mention in terms of actually using this system or any system, one thing I always tell people is I like to boil the investment trading process down to as few words as possible. Okay, so I'd like to do that now.
Yep, sure.
Okay. Step 1, spot opportunity. Step 2, exploit opportunity. And if you stop and think about it, that's everything that you need to know as a trader. In other words, everything you do as a trader investor fits into one of those 2 categories. You're either trying to spot an opportunity that's better or you find it more quickly, and then you have to figure out how to exploit that opportunity. Okay, so I've just talked about spotting an opportunity, seasonal trend, end of the month, middle of the month, holidays. In terms of exploiting that opportunity, one thing that people can look at who are interested that they can consider is it's a mutual fund called, it's a RYDX fund, ticker RYTNX. And what that does is it emulates the S&P 500 times 2 on a daily basis. So it's leveraged, okay? Now, to be honest, I'm not a huge fan of leveraged mutual funds and ETFs because over time, they don't always perform the way they're supposed to. But for short-term trading, they're excellent. And with this system, you're never in the market for more than 7 to 10 days at a time. And so again, just to give you a number, that fund started trading in about June of 2000. As of the end of last month, the Dow during that time has gained 72%, because we had the big bear markets, down. Yep. Then we had the big recent rally. So in that time, since 2000 to 2015, the Dow has gained 72%. Trading the system that I mentioned with RYTNX has gained over 1,600%. Okay, so again, we're talking about finding an opportunity and then figuring out a way to really take advantage of it.
Yep, okay. Just one more question on seasonality before we discuss exploiting it a little bit more.
Okay.
The month of October is often regarded as perhaps one of the worst or most dangerous months of the year. Mm-hmm. What do you think about that?
Actually, September is the worst month of the year in the long run. Historically, I don't have the numbers in front of me. October is a scary month because that's when a lot of market crashes have occurred. And so it's important to be alert, but basically if you are following the market and you're looking at, if you have some kind of moving average that you can follow, whether it's 50 days, 200 days, as long as it's above that number, there's nothing to fear in the month of October. But like I mentioned, it is in my book. I don't have the numbers in front of me, but the month of September is the only month that has net lost money in the Dow. In other words, if all you ever did was buy the stock market at the end of August and sell it at the end of September, you would actually have lost money over the last 70 years.
Mm. Okay, so as you mentioned, it's one thing to know about these seasonal tendencies, and you cover a lot more in your book. Mm-hmm. Now let's get to exploiting opportunities. How do you actually build all of this seasonal tendencies and understanding into a proper trading model?
Well, it depends what you're looking to do. The one that I mentioned is pretty simple. It's pretty straightforward, but it requires a lot of discipline. Because, for example, again, just one more moment on the daily or the monthly seasonal. If it's almost time to buy, and then you read that the Fed is about to make a major announcement, or Apple's about to make an earnings announcement, or a million other things that can get inside your head, and you fail to follow that. Mm. So again, it just depends what you're trying to do. I will mention this. Here's another system, and I haven't written this one on my blog yet, but it's coming up. I'm just going to spell it out, okay?
Sure.
December and January, we hold the S&P 500. February, March, October, and November, we hold retail stocks. Month of April, we hold energy. May, June, and July is in intermediate-term government treasury bonds. August and September is in gold. And that's it. You do it over and over and over again. And just as a side note, the summer months, that May, June, July, even August, if you look at the performance of the stock market, it's typically, in the long run, it's made no money during that time frame. Sometimes it goes up. That's where that whole sell in May thing comes from. Yep. Sometimes it goes up big. Sometimes it goes down big. Sometimes it goes nowhere. I know we're not on the topic of options, but for people who trade options, the summer months, if you have stocks, that's a great time to sell out of the money call options, because there's a good chance they're not going anywhere. Anyway, back to the system. The one that I just mentioned, if you use the model that I have uses fidelity funds. And so just again, to give you an idea of returns, $1,000 using what I just mentioned, switching every month, no questions asked. At the end of 1989, $1,000 through the end of September this year has grown to over $200,000. So, again, people will say, well, why does that work? Why is it? And the answer is, I don't know. But I look at 26 years of consistency and say that, that looks like a decent system to me. And then everybody else has to kind of make up their own minds. Mm-hmm. Okay. And then another side note that I want to mention in terms of kind of like the bigger picture of trading.
Yep.
The big bugaboo in all of trading, whatever it is that you decide to do, is drawdowns. In other words, you start trading something, and when you're making money, everything's fine. It's when things go bad, that's where you separate the wheat from the chaff right there. And the big danger is, of course, that you will have enough of a drawdown that you say, that's it, I have to stop trading. And, everybody knows that it always happens at exactly the wrong time. The pit of despair, when you get out, it happens to everybody, but and then something will turn around. So I talked before about the difference between specializing in one thing and diversifying among a number of systems. Another reason that I prefer to use a number of systems is this. It's kind of a rhetorical question. If you happen to be trading 10 different trading systems, maybe that's extreme for most people, but just for example's sake, if you're trading 10 different systems and one of those systems has a 50% drawdown, okay, well, that's only 5% of your overall portfolio. So you can trade through that. If you're only doing one thing, if you're specializing, you're using one system, and that system happens somewhere along the way to have a 50% drawdown, that's going to be a problem. Okay, so that's another reason to at least consider diversifying your strategies among a couple of different approaches. And the reason I mention that is that the seasonal sector system that I just mentioned had a 50% drawdown right during, of course, 2008. And so if that was all you were doing, it would be pretty simple to go at the time, wow, this is really bad. I'm gonna have to stop using this. Mm. But since that time, it's up over 600%. So again, just kind of making the point, if you diversify your approach to the market, while one system is making money, maybe something else is losing, but they can kind of offset each other in the long run.
Yeah. Okay. If I could just jump back actually to that seasonal sector model.
Yes.
Now, some people listening may be skeptical and they may think that's just a case of data mining, right? So what would be your response to that type of skepticism?
Well, the only thing I can tell you is that particular model I've personally been following since about 2005. So it did really well in 2005, 6, 7. As I mentioned, 2008, it got clobbered. And then since then, it's up over 600%. So, what I usually tell people is this. In terms of coming up with any system, there's data mining involved. That's the only way to come up with it. The question is your level of confidence in what you're using. And that's really what it comes down to. The bottom line is this. The keys to successful trading are, number one, if you have an objective plan with a realistic probability of making profits in the long run, that's a big step forward. And when I say objective, it doesn't have to be set automated rules, but if you have some guidelines, if you have some parameters that you can come back to on a regular basis, you're far ahead of the game. I do know people who trade the market by the seat of their pants and do very well. My frank advice to anyone, especially people starting out, assume you are not one of them. Okay? It's like every kid thinks they're Michael Jordan, but probably they're not going to be.
Yep.
So if you have some rules, something you can come back to, and you have some reason to believe it's going to work, again, if you just data mine, all the data from 1902 until today, you can find some great things. The question is, what's it going to do going forward? Mm. If you have something that you've got 10 years of real time and then another 20 years of back tests, either you're confident with it or you're not. It's a personal decision, And then the other key to successful trading, once you have that plan, is to have the financial and emotional wherewithal to follow that plan. And that's actually the tougher part nowadays. The first part with computer power, you can find all kinds of great systems. Even online, you can find all kinds of great ideas for trading that do pretty well. But the question is, fear and greed are, human nature is unchanged no matter how fast the computers are. And so, do you have the wherewithal to follow your plan?
Okay, we might discuss a bit more about successful trading in a minute, but if I can just ask you about a concept in your book called the Known Trends Index, or the KTI.
Okay.
Can you explain a little bit on what that is and how it can be applied to trading?
Sure. Basically, in the book, there are about 13 or so different seasonal trends that I write about. And most of them I got from other people, to be fair. Again, I mentioned Norman Fosback and Yale Hirsch, Sell in May and Go Away, all those things. Certain cycles, 40-week cycle. I would encourage people to, if they go to jayonthemarkets.com, do a search for the 40-week cycle. I haven't written about that in a while, but that one's kind of interesting. Anyway, they all they're in the book because they all individually have a pretty good track record in terms of identifying favorable periods in the stock market. So at the end of the book, put them all together, and I call it the KTI, the Known Trends Index. And the reason is you can actually, because they're all calendar-based, you could map them out from now until doomsday. So they're known trends. And what I have really found from a trading perspective is when the number is +5 or more. In other words, when you have a lot of those factors all together, that is typically a very good time to be aggressive in the stock market. In other words, you take 5 seasonal trends that have shown a good track record over time, and you put them all together and you say, wow, a lot of these are coming together at the same time. That's a good time to say, all right, I'm going to be more aggressive in the stock market. And you can take it another step beyond what's in the book and say, if the Dow happens to be above its 200-day moving average and this index is above 5 or at 5 or above, that's pretty strong indication that the trend is going to be good. And so, that's basically how I use that.
Okay.
And just for readings of, it can technically go below 1. It can go to -1. Readings of 1, 0, and -1 are typically followed by or accompanied by some, very underperforming market periods.
All right, thanks, Jay. So I'd just like to switch topics now to successful trading and some of the reasons why people fail to become successful traders. So,
sure.
Excuse me. What are some of the biggest mistakes you think traders make that impact their level of success?
Well, the number one thing is the lack of a plan. I mean, when people start out, if you think about a person starting a business, they usually spend a lot of time, effort, and energy devising how they're going to go ahead and make that business work. When it comes to trading, people just go, hey, I got $5,000. I'm going to put it in an account. I got a friend who's trading stocks. I think I'm going to give it a whirl. And then they bounce around from idea to idea. I mentioned before, you can go on the internet and you can find all kinds of great trading ideas. Problem is, you find one today and you start using it and it works for a little while and then it doesn't work. And then you switch to something else. And then you switch to something else after that. Also, the other part of a trading plan that's really important is the really boring stuff, the stuff that people don't like to think about. For example, what exactly am I going to trade? Am I going to trade individual stocks? Am I going to trade ETFs? Am I going to trade the British pound? Having an idea of what you're going to trade, and then also to have the discipline to say, okay, these are my trading rules. This is what's going to get me into a trade. And then also have other rules or parameters that say this is what I'm going to get out of a trade with a profit. This is what I'm going to get out of a trade with a loss. The other thing that's really important and unbelievably boring is position sizing. That is such a huge part. Because if you allocate 100% of your capital to every trade, eventually something very bad is going to happen. On the other hand, if you only allocate 1% of your trading capital to every trade, even if you happen to be the Michael Jordan of trading, you're just not ever going to quite make enough to make it worth your while. So it's kind of finding that balance and doing the work ahead of time to know exactly what you're going to commit and how you're going to get in, when you're going to get in, and when you're going to get out. It's like I said before. I keep using the word boring, but if I go into a room to teach a seminar and I say the words risk management or position sizing, I can see people's eyelids start to get a little heavier. Oh God, he's not going to talk about that, is he? But It's very important.
Yeah.
The other thing that's important is risk control.
Hmm.
Whether it's futures, whether it's options, stocks. The way I've heard it put best is, if you take care of the losses, the winners will take care of themselves. That's not entirely true, but it's a good message, because it's how you handle the losses that separate the winners from the losers. Whether that's position sizing, whether that's stop loss orders, etc. Another book I'll mention that I think everybody should read, Market Wizards. Yeah. This is from way back. And if you happen to sit down and read that book, you will read about risk control over and over and over again from all of those traders, because they realized, most of them had experience where they did really well and then they blew up and gave all the money back. It's just really important to have a handle on risk. As I mentioned before, if you're trading and you have a 50% drawdown, you're probably going to stop trading at just the wrong time. And then the last thing, I kind of mentioned it before, was the lack of discipline. I mean, you can come up with the greatest trading plan in the world, but if you don't follow it, I've seen it, I've done it myself. You're sitting there and you're supposed to do something according to your plan. You're supposed to get in, you're supposed to get out, whatever it may be. And you just, based on gut instinct, you go, no, I'm not going to do it. And you're sitting there and you're kind of like waiting for the trading police to show up at your door. Okay, buddy, come on, we know you're not following your plan. But they don't show. And so then it becomes a little easier the second time to deviate from your plan, and so on and so forth. So that discipline, like I said, if you have some kind of rules that you can come back to, that you feel comfortable with, and you keep coming back to them, you give yourself the greatest opportunity for success.
Yeah. Okay. If we can just talk a little bit more about risk control, because you have, in our chat today, you've kind of touched on a couple of aspects throughout the chat. So what methods can traders use to control risk?
Well, part of it, it depends what you're doing, but, diversification can reduce risk to some extent. I found that using different systems can reduce risk. And I'll give you an example. When I was the head trader for a CTA, we had 3 different systems. And for lack of a better phrase, we'll call them long-term, short-term, and intermediate term. And what was interesting, what helped us, was the interplay between those 3. In other words, if one system was bullish, and one system was bearish, and one system was flat, we had no position. We had no risk, which, if you think about it, makes perfect sense because there was no consensus. Right? We had a mix of ideas. If 2 systems happen to be long and one system happens to be short, then we have a long position in the market. Okay? And then if they're all 3 bearish, then all of a sudden we have a very aggressive position on the short side, which is exactly what we would want. So, when I talk about diversification, I'm talking, again, more about, types of systems that you use, types of approaches that you take, rather than so much of a diversified portfolio of stocks. Other things in terms of risk control, again, is position sizing. If you are going to trade, I'll go back to futures trading. If you say, okay, I'm going to trade up to 5 different markets at one time, it makes a big difference whether you're allocating 2% of your capital to each trade or whether you're allocating 20% of your capital to each trade. Because or somewhere in between, it's going to have a very direct effect, not only on your profit, but more importantly on your size of your drawdowns. So again, it's important to find that trade-off, and that's where back testing. Like I said, you mentioned people worry about curve fitting, but if you can actually back test a couple of strategies and put them together and actually view what the equity curve looks like, that's a huge advantage. And it's a little more complicated, but it can be done nowadays with software, with Excel. And if you have some idea of what your worst drawdown should be, that's a huge advantage. For instance, I'll go back again to CTA. When I was a CTA, we always told our investors, anything less than a 20% drawdown is noise. If you ever see that we have a 21, 22% drawdown, call us up and say, what the heck is going on? Anything less than that, we have sized our positions accordingly so that we should never get beyond that level. and we never did. And then the last thing, of course, is stop loss orders. And, there's different schools of thought on everything. And it's important for people to kind of figure out what they're comfortable with. Some people say you should put your stop loss order in the market so that it's there. And other people say, no, if you put it in the market makers will know it's there. They'll run your stop and you get stopped out. And I don't think there's a right or wrong answer for everybody. Me personally, I am in the put the stop in the market camp. Only reason being, I mentioned before about having that emotional wherewithal. If you get into a trade and you say, okay, if it goes down to a certain price, I'm going to get out. The easiest thing in the world is when it gets down to that price to go, I don't want to take a loss right here. I'm just going to give it a little more room. And, anybody, there are people listening to the sound of my voice, shaking their heads going, yeah, I know, been there, done that. And that's just, so that's my own personal approach is put the stop loss in the market.
Yeah, right. Okay, thanks, Jay. So we'll start wrapping up now with a few quick closing questions.
Okay.
The first one, what's the biggest lesson you've learned through trading?
Wow, that's a good question. Well, okay, I can answer that. Here we go. Here's what I always tell people. In fact, I gave a talk last week downtown Chicago, and here's what I told them. Market truism number one is this: bad stuff happens. It just does. And your number one job as a trader is to prepare for, survive, and get past the bad stuff. In other words, the job is not to go, oh my God, I can't believe this happened. Oh, this is terrible. I'm telling you now that bad things will happen. Anybody who's listening to me who's been trading for a while, they know exactly what I'm talking about. They've seen it happen. Things are going great. All of a sudden, out of nowhere, something unforeseen happens. Your job is to be prepared for that. In other words, when I go talk about a trading plan, how are you going to handle the bad stuff? Okay. And, basically like Murphy's Law, whatever can go wrong will go wrong. I always tell people, market truism 1A is Murphy hates you. Plan accordingly. That's good advice. Trust me.
It is. That's awesome.
Yeah. And the other thing that I tell people, and again, some people don't necessarily agree if they want to specialize. My opinion is there's no one best way to trade. In other words, if you listen to me or you listen to anybody else, you go to a seminar and they start saying, in order to be a successful system, in order to be a successful trader, you have to fill in the blank. What they should be saying is, in order for me to be successful, I have to. You have to figure out on your own what's going to work for you. And so it's important to take in ideas from people and then to be able to filter those back out and say, you know what, I think that's a good idea, but it's just not my style. Or, gee, that's something I hadn't thought of before. I can use that. So those are, those are some of the things that people need to focus on.
Yeah, cool. All right. Thanks, Jay. So what's the best trading advice you've ever received?
Wow, these are good questions. Gosh. Well, I have to go back to what I said before. It's, handle the losses. Think about how you're going to handle the losses. If everything bad that happens to you as a trader is something that you can handle, you're going to do very well. You're going to make a lot of money. It's not only the financial hit that you take when things go bad, it's also the psychological effect. In other words, anybody who's traded and lost money, there is a feeling you get in the pit of your stomach when hard-earned money is going out the door based on something you didn't foresee or you did something stupid. And that can affect you on the next trade if you let it. And so you have to really prepare to handle those things. That's why position sizing is so important, to get it just right, to say I'm going to put enough money into a trade where I can make good money. But, I guess one of the best things I heard was, I think it was Larry Williams, a futures trader, said, go into every trade saying, what's the worst thing that can happen? What's the worst thing that can happen with this trade? And if you can handle that, then it's a good trade, even if you end up losing money, because you're following your plan. Okay? Yeah. So, if you can handle the losses, if you can handle the bad stuff, then the good things are going to be, Easy.
Yep. Okay. All right. And what's the best way for listeners to get in touch with you?
Well, the easiest way is to go to my blog, and you can leave a comment, and I always respond to those. If you want to, I can respond privately, whatever. But that's the easiest way.
Yep. So that's jayonthemarkets.com, right?
Yes. All one word. Yep.
Okay, cool. I'll have a link to that on the website so that people can find it easily. So thanks a lot for your time today, Jay. Is there anything else that you'd like to mention before we wrap up?
No.
Okay.
Can I mention the account that I manage now?
Yeah, sure.
The program I mentioned? Okay, so again, it's just started last year, the Alpha Multi-Income Strategy. For more information on that, you can go to alphaim.net and look under the program performance and strategies page. It's a long-term. It's kind of different than a lot of things that I've talked about. It's kind of a long-term investment approach. Basically, if you're bullish, if there's a timing model, if it's bullish, we're in the market trying to earn above average dividend yield while being correlated to the stock market. And if it's bearish, we get into intermediate term treasury bonds. It's kind of as simple as that. But basically that's it.
Okay, great. Thanks, Jay. I'll have a link to that website on mine as well, so people can find that easily. So thanks a lot for your time today, sharing insights into seasonality, trading success, risk control, etc. So yeah, thanks a lot for that, and I wish you all the best for the future.
Thank you, and I appreciate the invite and the opportunity to talk to your readers and listeners.
All right, thanks a lot, Jay. Cheers.
Okay, bye-bye.
Bye. Thanks, Jay, for such an enjoyable chat. Jay mentioned a number of seasonal tendencies along with methods to exploit them, either by including them in existing models, trading them individually, or combining them into what he calls the known trend index, which his research has shown increases the odds of a favourable move when confluence occurs. Some of the returns he mentioned could also justify further research if that type of strategy interests you. But even if you're not interested in trading seasonals directly, it may be worthwhile to keep them in mind when developing your own trading models. If you'd like additional info on this week's episode, or just have a question or comment, head over to the show notes page at bettersystemtrader.com/34 and you can get all the details there. Anyway, that's it for this week. I hope you enjoyed the chat with Jay, and thanks for listening to Better System Trader. Catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.